Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. And I've put together the top 7 key market drivers I look at when analyzing a real estate market. Go to sethferguson.org to download your free copy. Our guest today is a real estate investor, accountant, and speaker with 30 years of real estate experience. He's also the author of the book, The Tax Smart Landlord. Ted Lanzaro joins us today. Ted, welcome to Purchase to Profits. It's great to have you on the show.
Great, Seth. Thank you so much. I appreciate it.
Yeah, really looking forward to this. So let's kick things off and tell us about your real estate goals right now.
Well, my real estate goals right now are to sort of, actually, I've taken a break from doing some investing the last couple of years to write the Tax Smart Landlord and to sort of build up my CPA practice in anticipation of future buying opportunities, to build some cash flow for future buying opportunities. So now I'm starting to look and get back into real estate investing, and my goal would be, right now, I'm looking for 2 things. I'm looking to pick up a couple of good cash flow properties, and I'm looking for one big development opportunity somewhere here in the state of Connecticut. I've always been sort of a smaller investor from the standpoint that I would buy single-family houses, small multifamilies. I flipped a lot of houses, single-family houses over the years. And, you pick up, you pick up a little bit of money here and a little bit of money there. I think I averaged about $25,000, $30,000 a flip when I was flipping houses from 2002 to about 2015. So now I want to try to find that one big deal where instead of making $25,000 or $30,000, you make $300,000 or $500,000, something like, converting, we have a lot of old mills and factories here. And so people are buying them up and converting them into either, apartment buildings or elder care facilities, that sort of thing.
Yeah. And having that, you talked about building up your practice to have strong cash flow. That business with strong cash flow and then real estate investing, that's such a powerful combination because all that cash flow coming off the business can go right into acquiring properties.
Yeah, that's exactly right. I get to the end of April, and I'm super duper busy from January through April, obviously as a CPA. And I get to the end of April and I'm sitting on, a fair sum of money typically, right? So now what do you want to do with that money? You want to invest it, right? And so, I typically will put some into a 401k or whatever, but I'm a real estate investor, so I'm kind of a hardcore, I like to be able to go out and touch it kind of investor. And so typically I would use that to buy properties. And the last couple of years I've used it to invest in other people's passive deals. But, going forward, I think I'm going to start doing more active investing again.
For sure. And what got you interested in real estate investing? Were you a CPA when you first got involved in real estate, or was it the other way around?
No, yeah, I was a CPA. I was working for a small firm in Boca Raton, Florida. It was about the year 2000. And I had I went to high school down there, so I had some friends of mine. We were talking one day, and this friend of mine says, "You got to read this book I'm reading, Rich Dad, Poor Dad." Right? I'm sure a lot of investors, quote that one, right? So I said, "Sure, right?" And so I started. I got the book and I read it, and I was like, there's a lot of very interesting stuff in here, right? And I had always been a CPA working in construction and real estate for the firm that I worked in. So I saw the kind of money that my investor clients were making, right? So I said, this is a good idea. I'd be willing to do this with you guys, So the 3 of us formed a real estate partnership, and we went out and we started buying houses. And the first day my buddy and I went out, we bought 3 houses in Fort Lauderdale, Florida, 3 single family houses. And literally the first day. And we went, and just to show you how dumb we were, right? So there's the low light, you were talking about, highlights and lowlights. The low light is we put our names, all 3 of our names on each of the 3 mortgages, right? Kind of a dumb move, in retrospect, right? So we buy and we fix up these three houses and we get them rented, right? So this starts now we're like, okay, well, now what do we do, right? So we start looking around, and we started finding other houses, and we went into sort of that kind of buy, renovate, refinance kind of model, right? And we started picking up those kind of properties, and then subsequently we ended up buying a small like apartment complex down in the Hollywood, Florida area. And at that point, it was about, give or take, it's probably 2003, 2004. We sort of settled in because we had mortgaged ourselves out essentially, right? So we didn't know really what we were going to do after that, And we still occasionally picked up a good flip, here and there, but typically we were just at that point we had gone from buy and hold investors to kind of fix and flip investors because we couldn't get any more mortgages to hold.
Yeah, and that's something a lot of people run into. They hit that wall, the financing wall, right?
Yeah, and that's what we did, and we did it to ourselves because had we been smart enough at that point because each one of us was making pretty good money at the time. So if we had been smart enough, and these weren't expensive houses, we're talking about $120,000 houses, right? So we're not talking about big mortgages and stuff. And this was sort of the beginning of the time when if you could fog a mirror, you could get a mortgage, right? So we went about it the wrong way, but had we started with, hey, you put your name on this mortgage, I'll put my name on the next house, and just sort of rotated that, we wouldn't have tapped ourselves out as quickly.
Yeah, for sure. So did you develop any routines and rituals that help make you a successful investor?
Well, I think we did, but it all came from sort of trial and error, because, like when we first started, we really didn't know anything about what we really were doing. Like there's professional landlords. Well, we were sort of the opposite of that, right? And there's professional rehabbers, and we were sort of the opposite of that, right? So, for the first rehab we did, they literally, the workers were sending me to Home Depot to get, they'd call me at my office and say, we need some paint or we need some, plaster or whatever. And Dum Dum would go and run to Home Depot and bring them, a bucket of plaster or a bucket of paint or whatever they needed. I'd go rent them a power washing machine, right? So, really not having, like any kind of system, just like sort of being totally reactive, right? And it wasn't until later that I actually sat down and developed a system for doing all of this stuff and saying, okay, this is not the right way to do this. We know that. And I had taken some coaching and some courses, right? And so I sort of kind of figured this out. Look, if I'm going to be in this business, there's a process to all this. So so subsequently we started doing processes. I had always known how to analyze a property, right? I got that much better at the property analysis. So when we were looking at, say, for example, a fix and flip, I could walk through a house with just a pad of paper and a sort of a checklist that I developed, and was able to kind of just calculate repair costs and make an offer, calculate ARV, calculate repair costs, and make an offer right on the spot, which always is the best way to do it if you're in front of a buyer as opposed to going back later with an offer. So I was able to do that. So that was part of the process that we developed, was the sort of one-step checklist for being able to, hey, we get a call, we know the address, we make the appointment. Before we go out on the appointment, we check, we figure out what the after repair value of this house, what we think we could sell it for, when we're done. And then I would go out, estimate the repair costs, and I would know right then and there, this is a deal, we're going to make an offer. And most of the time I had a contract, a purchase and sale contract right in my folder, right? And just ready to fill out. Or no, we're going to pass on it or whatever, it's not a deal. And you get a lot of those too. Right.
Yeah.
And the same thing with the rental properties. In other words, we would know what market, we would go out and look at market rents in an area. We would know what the market rents were. And then it was all about going out and trying to, see what kind of condition the property was in, what kind of deferred maintenance it needed, that sort of thing, so that we knew, hey, we could, if we buy it for this and we rent it for that, there's X amount of cash flow. We were able to figure that out sort of on the spot.
Yeah.
And this was before everybody carried a laptop or a tablet with them, right? So this was pad and paper,
Yeah. And I think the key there is like you did your homework ahead of time and you showed up prepared so you can make a decision on the spot instead of seeing the house, then going back, doing a whole bunch of research, because then you were able to act very quickly.
Yeah, I think that's honestly the key to really being successful when you're buying properties, is to be able to walk into a property that you want to buy. Okay. Now, this is not for bigger stuff. This is the small stuff. This is the single family houses, the multis, small multis, but being able to walk in there and say, look, I've already done my homework. I know if repair costs are below this, it's a buy, right? And if cash flow is going to be above this, and we set a criteria, it's a buy. Make an offer right there, because anytime, again, we would spend quite a bit of money on marketing. So when you got leads, you wanted to make sure that you were really maxing out the benefit of the leads that you got, because they're expensive, right? So doing all that additional prep is part of the process of being able to basically make an offer in a vacuum, because those people called you, the property's not listed, nobody else really knows about it. If you can get it signed up right there and then you're going to get a lot better deals like that than you are, say, chasing deals on the MLS, for example, where every other investor in town knows about that deal.
Yeah, well, 100%. And you're in a great position because you've got the accounting background and then the real estate background. So a lot of brand new real estate investors, they don't even think about tax implications or anything like that when they first get started. What are some of the most common mistakes you're seeing people making on the accounting side when it comes to real estate investing?
Yeah, there's a whole bunch of them. Okay, so the first one is not knowing what records to keep, not knowing how to keep records, right? And so I always tell people, look, if you're starting a real estate business, right? Let's say you're going to set up a company to do that. So you set up your LLC, right? And you open a bank account. That's the biggest thing. Now figure out how you're going to have every transaction that you do, every expense you pay, every amount of money that you make income-wise, how is that money going to flow through that account, right? So if you have to pay, so you start up, right? Well, put some money don't pay your bills out of your personal account, put the money into the business account and pay for the marketing and the administrative and all of the stuff that you need to start up, right? And then once you start, buying houses and that sort of thing, you can collect the rental income and pay the bills all out of that account, instead of doing what a lot of investors do, which is they pay this from this account. They go to Home Depot with a personal credit card, and now you're like, okay, well, I need to do your bookkeeping. Okay, yeah, here's the 5 bank accounts, none of which are actually designated to this business that I had activity, but it's all mixed up with all my other stuff. And here's the 6 credit cards that, everything's mixed up too. Now try to figure out, what's real estate related, right? As opposed to my system, which is, hey, pay everything out of one account, right? Fund the account, pay everything out of one account. If you put something on a credit card, reimburse yourself out of that account. Then, because at the end of the year, if you've done absolutely nothing, all we have to do is print out your bank statements, get your check, get copies of your checks, and we can figure out what you did.
Yeah,
all year, right? The second thing that people do is they don't realize what deductions they're actually entitled to. So they miss a whole bunch of deductions. And in the Tax Smart Landlord, there's actually 2 chapters about. One chapter is about all of the property expenses that you're entitled to deduct, right? And most people know about those, okay? So most people are going to deduct their mortgage interest and their real estate taxes, their insurance, their repairs, that sort of thing, right? But the second chapter is about the kind of administrative expenses that most investors actually miss on their return. And even if you're a passive investor and you're not able to take rental losses against your earned income, right? You still want to take all of these administrative expenses to build up the carryover that you will use sometime in the future, right? So it's things like auto mileage, right? A portion of your cell phone, a portion of your internet, all the things that you're paying for probably are not able to deduct as just a regular person, right? But now that you're in the real estate business, you can allocate a portion of those expenses to your real estate business, and there's a whole list of them.
Oh yeah, and real estate. I love real estate so much because of the tax benefits. Even when you get into the larger syndications, you've got cost segregation, like all that stuff is amazing.
Yeah, exactly. I mean, and the whole idea of investing in real estate at any level, right? And I'm involved in some larger syndications also, and certainly from the CPA firm level, involved in a whole bunch of them, right? And that's the cost segregation is one of the biggest strategies that we use, because the whole idea of investing in real estate is I'm going to get cash flow in money in my pocket, right? That I'm not going to have to pay taxes on, because I'm going to apply a depreciation deduction against that rental income, and I may have cash flow, but I've got a net tax loss, right, because of the depreciation. So I've got money that in my pocket that I don't have to pay taxes on, and that's the whole idea of investing is to have that sort of tax-free cash flow. What I heard somebody call real estate is the last great tax shelter.
Mm-hmm. Right? Yeah, well, 100%. And those were some really good tips he gave us. Let's talk about a keystone deal. So a deal that made a big impact on you. Is there one that comes to mind?
Yeah, you know what? I mean, it's sort of a funny story, but it's not a big deal, right? But it was we were at some point relatively early in our career. We kept driving by this one pretty nice house in Boca Raton, Florida, weeds overgrown, everything, right? And so we went to the courthouse and we found out who owned the property, and we sent them a letter. And we said, hey, we'd like to buy your house, right? And we knew that the house was probably worth, I don't know, maybe $250,000, $300,000, if we fixed it up, right? So one day we get a call on the letter, and the guy says, hey, this was my uncle's house. It's been empty for like 6 years, right? You guys want to buy it. You can, just give me a price, And so we gave him a lowball price, right? Maybe we paid like $120,000 for the house, right? And so I can remember the first day we're getting the keys, we knew it was his uncle's house and that, right? And we walk in there, and the only thing in the whole house is a rolled up carpet. Right? And I'm thinking to myself, geez, I hope his uncle's not in there, right?
Yeah.
And so, but we cleaned it out, right? And so here's sort of the dum-dum part, right? So what's the first thing you would necessarily do as part of that rehab? We did the clean out, right? But we started working on a couple of things that you normally wouldn't even work on. In other words, the yard was so awful that the first thing we did was we had a guy come and like literally, bulldoze and graze all the plants and old stuff out, so that the yard wasn't full of like garbage and old trees and plants and stuff. Right, and then we laid sod down. Now that wouldn't normally be your first step in a rehab, right? So we're sitting there, one day, and we're kind of working on the house, and this car pulls up, and this lady says, "Oh, what are you going to do with this house when you're done?" And we're like, oh, well, we're fixing it up to sell. And we hadn't done anything except the yard work. And I think we had some guys on the roof that day that were pressure cleaning the roof. And she said, well, do you mind if I go and look in the house? And she walked in there, and she's like, I'll give you $225,000 for it right now as is. Sold. Right? We're like, wow, okay, well, yeah, where do we sign for that? Right? So we ended up doing that deal. And what was funny about that was about a week later, the guy who owned that house called us back, and he said, you know what? He's like, my brother has a house just like mine right down the street from that house. He's like, would you guys be interested in buying that house too? We're like, Yeah, totally. And we went and looked at it. It was basically a very similar situation, but it was like, it was in a state or whatever, right? And we ended up picking up that house from that same deal, and we ultimately fixed that one up and sold it. But it was like probably some of the easiest money that we ever made, right? So now let me give you the downside. I'll tell you. So that's a good one, right?
Okay, yeah.
I'll give you one negative one, right? So at one point, we got an opportunity. We lived in Boca Raton, Florida, and we got an opportunity to look at a house in Vero Beach, Florida, which is about probably 2 hours north. Okay, right? So one of my partner's sisters lived up in that area, and she's like, they've got this house up here. It's it needs to be rehabbed or whatever, but the people want to sell it. It's like 6 houses from the beach, right? So cool. We go up there and we look at it, and because it was 6 houses from the beach. It was a more expensive property. Maybe they had it listed for like maybe $350, right? And it needed maybe $100,000 worth of work, right? So we're having, I had one partner who would do anything. I was sort of the mediator, and the other guy didn't want to do anything. He was very conservative. So he's in our ear. How are we going to manage this property? We've got all these other things going on, and, how are we going to get the, so, we ended up not doing it, right? And so we just passed on it. So at some point, I started going to real estate investment club meetings, right? And I even started getting asked to speak at different real estate club meetings as a CPA and, real estate investor. So I ended up going to this, what's called the Treasure Coast REIA. I don't even know if it exists anymore, but Treasure Coast REIA was in Port St. Lucie, Florida, right? So that's kind of up in the Vero Beach area. So I go up there and I'm speaking at an event, and I end up just talking with a guy, right? And he starts telling me about this house he just got done renovating, right? And he sold. And you show him, and I'm like, I know that house. I looked at that house. Is that house in Vero Beach? And he's like, yeah. Well, it turns out he bought it, fixed it up, and sold it for a $250,000 profit, right? So now I'm like, I'm ready. I'm going to go back. I'm going to like wait till I find my partner. I'm going to give him an earful, right?
Yeah.
But that's, there was a lot of so you make you hit a few home runs, and you strike out a few times too.
Yep, but you have to keep swinging, or else you'll never get on base, right? Yeah, for sure. No, those were some great stories. So, what sort of impact then did getting into real estate investing have on your life?
Yeah, I mean, it's going to fund my kids' college. I have a 15-year-old and a 10-year-old, and their college at this point is basically paid for. Because what I did was I took a lot of the profits that I made in real estate, and that's how that's really what I was doing it for. I started, with the idea that the profits, I was making enough money as a CPA to support my lifestyle. This extra money was going to, fund my kids' education. And so that's initially what I did with it. And so yeah, they're all set. And then I always tell people, when people, if you've got a real estate mindset and you want to be an investor, and let's say you have a child, I would go and buy that child a rental property, right? Because 18 years later, when that child's ready to go off to college, there's a very good chance that rental property will be worth enough more than what you paid for it, and you can sell it and fund that child's education with it.
Yeah, no, that's such a good point. And like if we just bank on a property doubling in value every market cycle, so let's say every 8 to 12 years, that in 18 years that adds up, right?
Yeah, no, exactly. No, and I really, I really believe in that. Now, it's certainly not a perfect scenario, right? We've seen some pretty harsh market dips also. South Florida after 2008, the market in South Florida where I lived, that was sky high, crashed to the ground, and if you had cash at that point, the people who had cash left, you could pick up houses that would cost $2 million, like right on the intercoastal or whatever, beautiful houses, we're now selling for $800,000 or $900,000.
Yeah.
Literally literally less than half. And the market got, just to give you an idea of how hot the market actually got there at one point. In 2004 and 2005, I had clients that were making a really good living, $300,000, $400,000, $500,000 a year, buying and selling pre-construction contracts. So a housing development would be going up, or a condo development would be going up. There would be a pre-development sale. People, literally, investors would line up. They would buy all of the units they could get their hands on, right? And then literally, before the things were even built, sell the contracts to people who actually wanted them. Flip the contract instead of flipping the property. Now a lot of those people got greedy and got burned, in the downturn. But if you got out at the right time, man, you made money.
Yeah, you're playing with fire at that point.
You are, yeah.
Yeah, for sure. So Ted, if somebody's looking to reach out, learn more about what you're doing, get in touch with you, where can they find you?
Yeah, so I have an office in Cheshire, Connecticut. My phone number is 203-922-1742. I handle exclusively tax consulting for real estate investors. My website is www.lanzarocpa.com, and I'll spell that out for you. My last name, LANZAROCPA.com. And you can connect with me on Facebook, Ted Lanzaro. You can connect with me on LinkedIn. So there's a whole variety of ways you can contact me. And I get these days, a lot of contacts through Facebook.
Yeah, that's great. Ted, just want to say thanks so much for taking the time and sharing some really good stories with us.
Yeah, thank you. It was a pleasure, man. Thanks for having me on. Appreciate it.
Pleasure was all mine. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.